Welcome back to the show, Business Mastery for Startups, Scaleups, and Early Stage Businesses with your host, Jerry Gadori. That's me. And this week's guest, we have Will Kidston. Now, Will is the Chief Investment Officer and Partner at Kidston Capital Partners and the former Vice President running the Early Stage or Emerging Technology Fund for the state of Massachusetts. So Will knows a little something about the finance side of the tech and startup landscape here in the Northeast. Will, could you elaborate a little bit more on your background for us, please?
Yeah, thanks, Jerry, and thanks for having me on today. Real pleasure. So, a little bit of background about myself. My now partner and I used to run the Emerging Technology Fund on behalf of the Commonwealth of Massachusetts, primarily doing early stage focused venture debt lending. So primarily lending to seed to Series B stage technology and healthcare companies here in the Commonwealth of Massachusetts. We started Kidston Capital after having a great track record running that fund on behalf of the Commonwealth. Started Kidston Capital about 3 years ago. Closed our first fund last year, and we'll be going out to start raising Fund 2 sometime in the fall or early 2026. So a little bit more about Kidston Capital. Seed to Series B venture debt. We are primarily the first debt a company ever takes on. One odd criteria for us is all of our portfolio companies are losing money when we get involved, and hopefully our incremental capital helps them on their path towards sustained profitability and or an additional or a few additional equity raises along their journey in maturing the business. We write $1 to $3 million checks and usually do it to support 3 buckets of purchases: inventory purchases, new equipment purchases, and then our most popular financing bucket is financing human capital expansion for folks. Most of the businesses that we encounter are not only growing fast on the top line, but also growing headcount alongside that to continue to support their growth trajectory. And we found that financing that human capital expansion is a key driver to allow them to bring forward new hires, mature the executive bench, and really set the business up for success over the long term.
Well, I'm going to pause you there. A ton to unpack in what you just said. So we talk about general business topics for anything from ideation through about Series B. So a large chunk of what you just described. And I've had venture capital folks on the show before, but never a venture debt person. Could you talk to me about what the difference is between the two?
Yeah, great question. And I'll just start off by saying venture capital is the purest form of risk capital there is in the marketplace today. So pre-seed, seed, even Series A venture capital equity investors are putting their money at risk for outsized returns, right? A pre-seed, seed, Series A investor, they're underwriting to that X investment. Where we really thrive is stepping in once a business has gone through that ideation, development, testing, product market fit phase. So the risk to the business generally from going under versus succeeding is much higher on the succeeding side, right? We are lenders first, and our goal is to get paid back at the end of the day, right? Venture equity investors are very different, particularly at the earlier stages. So a pre-seed investor, a seed investor, they know that some of their portfolio companies are going to fail, right? But they're getting in at such an early stage that, yes, some of the portfolio companies will fail in a fund. The hope is that 1 or 2 will hit that X benchmark that basically makes up for all of the other losses. So, and they're underwriting all of those risks that I previously mentioned. So technical risk, founder risk, product market fit risk, competition risk, all of these things that come with starting and funding a company at its earliest stages, right? A pre-seed equity investor is going to be usually the first institutional check into a company. A lot of companies will raise a little bit of money from friends and family, we call it, let's say less than $1 million in aggregate, usually less than that. But then a pre-seed or a seed investor is writing a check anywhere from $1 to $5 million to really finance that company from ideation through attempting product market fit. So venture equity, pure risk takers. Where we play is a company needs to have that product market fit, right? The product is in a space where the company is selling it to a core group of commercial customers. The product is solving a significant pain point for those early cohort of commercial customers. And the product is protected by a large moat of IP, be it patents or proprietary internal information, which is more common in the software space. And we're really trying to add fuel to the fire of growth to ramp the repeatable sales cycle that these companies have established, albeit at a very early stage, right? And so a lot of the funds that we provide, particularly on the human capital expansion side, are used to build out the executive bench, hire a go-to-market function, so sales and marketing, customer success, sales engineers. And then if it's a software focused business, hiring another cohort of engineers to support the development of new product features or version 2 or version 3 of the product. If it's more of a deep tech company, so we primarily finance deep tech and health tech companies. If it's more of a deep tech company that has significant CapEx needs, sometimes we'll use 2 of the 3 buckets or all 3 of the buckets that we finance to support that company's growth. But in almost every situation, we're financing that human capital expansion. That one is the true fuel of growth, and then 2 is usually our portfolio company's largest cost, right? Particularly in an area like New England where headcount costs are pretty exorbitant in some cases, specifically for highly technical folks.
That is for certain true.
Yeah.
So as someone who's worked in that space for 30 years, can confirm. So let me break that down a little bit further. So venture capital firms are trading X amount of a check, X amount of dollars for Y amount of equity. Whether it's an angel investor or a true VC firm, they're giving a founder a check and they're receiving equity in return.
You're exactly right, Jerry.
Yeah.
Yep.
So venture debt, I understand, is different. How does venture debt work?
Yeah, so we're primarily a lender, right? So our portfolio companies have typically raised a couple of rounds of venture equity. So there's usually not a majority individual shareholder in the company. You have a cap table or a capitalization table that lists all of the equity holders of the company. That's fairly diverse, I would say. You'll have, let's call it 3 to 7 large equity holders, say over 5%, and that includes founders, early employees, and then the venture capital or equity investors that have contributed dollars in exchange for equity in the business. The reason that our product exists is the companies become mature enough where we are comfortable to lend money to them with the idea that we will start being paid back typically within 2 years. And so that's where it's important that the company has a repeatable sales cycle. It's growing profitably with good margins. And typically the company has some medium-term line of sight to cash flow break even or free cash flow generation, right? Because our number one goal is to lend money that helps the company grow profitably and then allows the company to pay us back within a 2-year time frame, right? So typically we're providing loans that have a 2-year interest only period. And at the end of that 2-year period, it works just like a mortgage where there's an amortization schedule and they start paying back both principal and interest to us. And so not every business, one, is set up for venture capital financing, so selling equity in exchange for dollars. And more so, not every business is set up for venture debt or borrowing money at a stage where the company is losing money, right? And so that's why it's still quite a niche market in the overall lending universe. And just going back to my comment of, not everyone's a fit for VC and not everyone's a fit for venture debt. There are a lot of really great businesses out there that are growing 20, 30, 40% a year that aren't just a good fit for the outsized expectations that venture equity investors would put onto the business. And I think you've seen this real bifurcation in the marketplace over the years where a lot of entrepreneurs are just doing the bootstrap route. They created a product, they've been able to go out and sell it profitably. They're growing at a sustained pace. They're profitable from either inception or shortly after inception. And those entrepreneurs just don't want to have to deal with the governance issues, the board issues, and the complication that comes with taking equity investment either from angel groups or family offices or institutional venture capital firms. And it's the same thing for companies that we look at, right? There are plenty of great businesses that we pass up every day because one, our funding model is unique, or two, maybe it's too early for us, or three, maybe the company has already eclipsed the stage where we think we could be most impactful. And in all three of those cases, there's nothing wrong with that, right? We're here to solve a capital gap that exists in the marketplace. And a lot of those companies that we pass up, we're happy to help them with other issues that they have too. We're big proponents of putting good karma out into the marketplace, and has definitely come back in spades to us over the years.
That makes sense. Now, I'd mentioned I've had VCs on the show before, and setting investment strategies aside, some focus on infrastructure-only software companies, some focus on, these days, it seems, only AI companies or SaaS, whatever it is. Setting that aside, they also have philosophical differences in what they're looking for in their startup. So, for example, some people are focused predominantly on repeat entrepreneurs, or they consider themselves an I invest in the team. Others, it's very much the concept. Obviously, there's things underlying that, like, product market fit and size of the problem and all that. But when I hear I'm a lender first, I'm thinking that your model would look more towards things like revenue, debt to income ratios, things a traditional lender would look for. Is that accurate? Or do you have a more, again, philosophy aside, do you have a similar criteria of what you're looking for in your ideal startup customer?
Yeah, so we at Kidston definitely have like an ideal credit box that we would look at, and you already touched on a couple of those things. And the space that we're playing is pretty unique in the venture lending world, where we're almost straddling the divide between traditional lenders and pure venture equity risk capital. We're playing at the earlier stages. And so to your point of looking at management teams, that's 50% of the equation for us.
Sure.
At an earlier stage, you basically have 1 to 3 founders or key employees who are driving the business to success. And a lot of cases of our portfolio companies, those 3 folks are technical. As the business matures, those technical folks may transition back into a pure technical situation, and a professional CEO may come in. Going back to kind of our credit box, it's who is the management team? What have they done previously? Were they in the industry, and did they recognize that there was a long-standing problem that they've now decided to solve? And that's a management team that we love. I think one kind of big difference, and this is a generalization, I'll admit. One big difference from East Coast to West Coast is that we have generally seen that the entrepreneurs on the East Coast tend to be a little bit older and come from industry. So they were in an industry for 10, 15, 20 years. They saw a problem that wasn't being solved, and they went out and decided to solve it. And so, boom, that's a big check for us. But then going back to kind of more business fundamentals, revenue. We look at businesses that are 2 million run rate revenue and above. They're capital efficient, so typically burning less than $250,000 a month. They're looking to grow headcount substantially. So typically our portfolio companies are 10 to 30 employees when we get involved, and they're looking to double or triple headcount over the next 2 to 3 years to support the growth of the business. Deep IP moat. So a lot of the companies that we're backing, I mentioned deep tech, health tech. A lot of the companies are spin outs from the research university, either pure spin outs where the technology is being licensed, or it's a team that met together while they were working in graduate level studies at one of the research universities and are spinning out as a group with an idea and then chasing it and forming company owned IP.
Trying to catch the next Bose.
Exactly. Jerry, we're lucky to live in such a rich area in terms of intellectual and entrepreneurial talent that it's always fun to see what the next generation is coming up with for technical ideas. It's fascinating. That's why I do what I do every day.
I couldn't agree more. MIT, WPI. My son's a WPI grad.
Yep.
Just amazing institutions. So circling back to one of the things you mentioned earlier about it not meaning a company isn't a good company if they're, not a good candidate for venture capital. Something that I think a lot of founders need to be reminded of is that less than 15% of all startups are venture capital eligible, in part because venture capitalists are looking for an exit typically in 5 to 10 years. And again, my background predominantly in technology services, that's almost never the case with us. Our exit options tend to be PE acquisition or larger firm acquisition are the two most common by a wide margin. In the venture debt world, I know you're not looking for that 100x, but are you looking for a similar trajectory to exit? Is that even a part of your equation?
So we certainly are looking for a liquidity event at some point. I would say our time horizon is kind of 5 to 10 years as well. We do receive warrants, so participation rights in equity in each company that we do a transaction with, albeit significantly smaller than a VC would get, right? We're typically between 1% and 0.5% on the cap table at the close of our transaction. So we do look to that equity upside, but a lot of our companies are on a sustained growth trajectory as opposed to a pure hockey stick. Let's say 20, 30, maybe 40% growth year over year. And at our stage, that's sustained, I would say. It's not explosive. At a seed stage or a Series A stage company, what a VC would be looking at is, 100, 200, 300% annual growth rates in terms of top line. But we're much more patient, and the companies that we back require that more patient capital because the timelines to exploit the markets are longer. So, in SaaS, you can quickly spool up a product and get to those explosive growth rates. You see it with all of these IPOs that are coming to market now recently. But when you're talking about things like robotics, defense companies, advanced manufacturing, med device, medical diagnostics, digital health tools, either the regulatory frameworks or just the building of physical products means that the timeline from ideation to product market fit just takes longer. And so there's a specific set of people on the equity side and then a specific set of people on the debt side, particularly as you get into larger numbers on the debt side, that have this focus because they like the patient aspect of it, right? It does certainly build a much larger moat around these companies. On the health tech side, it's regulatory mostly, but on the deep tech side, it's that moat of time, really. And so, going back to your premise of only 15% of startups are venture capital eligible. That's right. And what I would say is if you're considering that route, do some serious homework and say, do I want to take on these outsized expectations? Or do I want to build a business that's sustainable for the long term and I'm happy growing, 15, 20, 30% a year and, cashing checks to the bottom line? And that's a great way to make a lot of money, Jerry.
Well, no argument. What I love most of all, to be frank, though I've not, worked with you or anything like you in the past, is the idea of options. The more options a founder has, the more likely they are to have the fit that gives them, one more chance at survival to make it out of that abysmal fail rate. Finding just that right fit for that circumstance versus trying to shoe themselves into a VC relationship that in their use case might not be right.
No, you're exactly right. And we've backed any companies. We've done founder bootstrapped companies in the past, albeit that's not kind of our core thesis. But we play in a lot of companies where they took on one angel round or they're backed by a single family office. And we like those companies because we feel like there's much more of a relationship between us, the companies, and the investors that are backing the companies. And also those family offices that I mentioned, they seem to be generally more patient. And if they are bought into a company's problem-solving product, they tend to continue to fund that company to success, where the institutional VCs, if you're not hitting the original milestones, may pull back slightly in terms of continued backing.
No, agree. We've covered a pretty wide range of information today. Well, based on your extensive experience in the space, if you could share one piece of advice with a startup founder, what do you think that advice would be?
The one piece of advice, and this, I can't take credit for this, it comes from my partner, Jim, who's the gray hair in the relationship and the one with all the experience. But it's write a written business plan. And we ate our own cooking and wrote a business plan prior to launching Kidston Capital. And we continually revisit it probably every 3 to 6 months. And it's very important to do this because it keeps you grounded in what you thought the firm was going to be at X point in the future. And looking back, so the entrepreneur journey is so hard, right? You know it, Jerry. I now know it too, having set up Kidston Capital. But being able to look back at a written business plan and say, wow, we've done a lot and we've had a lot of success, I think is such a validation. But also going back and looking at that plan from 3, 4, 5, 6, 7 years ago even can open your eyes again to new opportunities that you may have passed over for whatever reason. And I think it's a grounding document. And I would encourage, and we always do encourage our entrepreneurs to continually update that business plan too, because things change, things go sideways, things go great, things go horribly, right? And what I've learned is that the written business plan really can serve as your North Star as you're going through this roller coaster that is entrepreneurship.
I couldn't agree more. There's an old military saying that no plan survives the opening of battle. However, the exercise is where the value is. Mm-hmm. It's not 10 years, fast forward 10 years, what you have is not going to be what you planned.
100%.
There's no chance, like near zero. But it provides, to your point, a grounding influence, as well as some at least initial metrics to base your decisions off of, and you're probably almost an inevitable pivot at some point. It gives you some criteria to make decisions off of. So I love that advice.
Yeah, it's worked well for us, and we were lucky when we set up Kidston Capital that we had been backing early stage entrepreneurs for many years, and so we literally sat down and did one side of the page, what did everyone do well at the companies that were most successful? And then the other side of the page was, what did everyone do horribly? And we said, let's try and do all the stuff that the successes had and avoid the pitfalls. I think we've done a pretty decent job of that, but there's always room for improvement.
It's interesting you say that. So I run my own company. I'm the interim CEO of a second company. I also do a lot of work in the startup community in coaching and mentoring founders. And I swear to you, I learn as much in these mentoring sessions as I teach. Both amazing ideas and frankly, because you can learn from the negative, just seeing some big mistakes, and being not only able to step over them myself, but help others ensure that they step over those as well.
And that's why this area is so fun to participate in, Jerry. I've loved it ever since I started about 10 years ago. It's been a great and fulfilling ride.
It really is. I'm an active participant in Startup Boston, Stephanie Rowlick's networking group, and it's absolutely amazing. We just had, at the time I was recording a couple of weeks ago, the Boston Startup Week event. And it's always amazing. Such a range of folks from college age to people as much gray in their beard as I have, and ideas from service businesses to just absolutely cutting edge technology ideas. It's an amazing area and an amazing time to be an entrepreneur.
Certainly, yeah, no, absolutely, Jerry. And I was actually on a panel the last day of Startup Boston Week talking about venture debt. And I was the early stage guy. We had a couple of folks who do much later stage and bigger checks, but it was a good conversation about generally how our market has kind of matured over the years, and that's to the benefit of all of the entrepreneurs out there.
Absolutely, yes. Well, listen, Will, you've been an amazing guest. I'm sure that the audience has gotten a great deal from the session, from this episode. If folks want to reach out to you and learn more about you, how can they do that?
Yeah, visit us at kidstoncapital.com. We've got a form you can fill out. We're always happy to talk to entrepreneurs. Like I said, we're big proponents of, putting good karma into the marketplace because it tends to come back to us. And you can catch me on LinkedIn at William Kidston. Just search me. And thanks so much, Jerry. This was a blast. Hopefully we can do it again soon. And thanks for having me on.
Oh, thanks for being on. You've been an amazing guest. Now, longtime listeners know that those links will be available in the show notes. New listeners, well, you just heard, they're in the show notes. Please don't crash your car trying to write them down. For everybody, continue being awesome, and thanks for tuning in to another episode of Business Mastery.
Thanks.